This is Scott Becker with the Becker Private Equity and Business Podcast. We try and join you regularly with short business episodes, short private equity episodes, interviews and discussions with brilliant private equity and business leaders. Today is one of those. We're joined today by Matt Wolf, one of the leaders at RSM, brilliant thinker on private equity and healthcare as well. Matt, what are you watching currently in the private equity space? What are you seeing? What are the trends you're watching?
Yeah, this is a little maybe outside or on the edge, Scott. But one of the things we've been trying to think through is, with the new macroeconomic regime change and interest rates and all the stuff that we talk about almost every week, how are strategic investors and divestors playing into this, and what does that mean for buying and selling opportunities for sponsor-backed platforms, companies, right? So, as we move and are sort of securely in this new world realm of little or less multiple arbitrage opportunities, financial engineering opportunities for private equity exits, we're also seeing on the other flip side of that, sort of strategic players, corporates, other organizations, looking at their portfolio of assets and making critical divestitures, either to raise cash or just sort of exit businesses that in a higher interest rate environment they don't think is worth it for them, and also to make very specific acquisitions. I've talked to several very large kind of health system organizations. Again, that's primarily my area, my sector of focus. And they're, ramping up their M&A professionals, their teams, but they're approaching deals very differently, right? Instead of just, I guess maybe take a step back, right? All of these deals are ultimately a build or buy sort of analysis for these strategic investors, and they're looking at this differently. And while they may not make up the lion's share of deal flow, depending on the sector, the industry, the time of year, whatever you want to look at. I think that they're really important players for private equity sponsors as they think about how to make their acquisitions or exits. And so just trying to think about and map out what does it mean for the private equity deal-making ecosystem as strategics sort of change their tact on acquisitions, get serious about it, but maybe serious in a different way, more focused on cash flow creation, acquiring new capabilities instead of just buying into new markets, and what might that mean for sponsors' ability to exit at potentially higher multiples.
And let me ask you a couple questions there, because for a period of time, private equity was all the buyers of almost everything. I know years ago we went to market with a company and we're very interested in a couple strategics, but private equity would give you the same price up front and you'd still own 30, 40, 50% of the company. So it became almost impossible for strategics to compete with private equity. Then the last few years, some of the huge strategics in any sort of business, and one of them I'll think about, just because it's front and center, is, Walgreens Boots Alliance bought Village MD for $5 to $7 billion. And then essentially they were strategic buying it versus selling and flipping to another private equity. That ended up essentially blowing up. And they did it exactly as you said, buy or build. They thought it'd be easier to buy it than build their own primary care network throughout Walgreens. And they found that either way, it was almost an impossible thing to do and crazily expensive. But what do you see sort of going forward in that strategic versus private equity buy? Are the strategics going to be more engaged this time around? It seems like it's years since the strategics were the primary buyer of a lot of things. What are you seeing there, and what are people expecting?
Yeah, I think to put a finer point on it, I think that in more cases, strategics will be able to recognize and rationalize the synergies that will allow for higher multiples, certainly for private equity exits. Now, we can talk separately about sort of founder-owned businesses taking their first institutional capital from a strategic buyer. That's a whole different animal. But on the private equity side, I think that's one upside on the exit, right? Is that strategics will be able to recognize, or at least will optimistically hope that they can recognize more of those synergies and be willing to pay a little bit for them, right? They're not going to pay for all the value they bring to the table, but in a competitive bid process, you can get that multiple up there above and beyond what most financial buyers would pay. And on sort of the other end of that spectrum, as these strategics look to exit certain businesses, they want cash up front. They're in many cases they're going to exit and sort of reduce the diversification of their portfolio simply because it's kind of a headache to manage all of these different base businesses. They're trying to slim themselves down, and that can create a favorable buying opportunity for the right sponsor with the industry or operating partner experience in that realm. So, these opportunities aren't going to be pervasive and everywhere, but I think strategics are getting more involved in M&A, and that creates both buying and selling opportunities for well-positioned sponsors.
And let me ask you another question about that. So many of these private equity funds have these benches of analysts and deal makers that are sort of in the deal making world. It seems like there's less and less of those big M&A teams at big strategics. Certainly at the biggest strategics, the top 20 companies in America, they are loaded with deal making people. The next level down of companies, the S&P 500 versus the S&P 100, do they have the capacity? And what do you see when you're talking with people about their capacity to do deals? We've seen this over the years. When you talk about the health systems, some mega health systems got very good at doing deals, and they did them over and over again. Others weren't really staffed for it. So every time they were doing it, it was like a one-off, and that's a prescription for disaster. What's your sense of the staffing and teams at big strategics, big health systems for deal making?
Yeah, it's a great question, and I think I would even extend that down to like the Russell 3000, right? These companies are recognizing that M&A can play a pivotal part of our strategy going forward. There are going to be opportunities to do deals, and then they have to think to themselves, okay, does it make sense for us to build out this capability in-house? Are we going to do enough deals to do this where it makes sense to hire this level of talent to execute on these deals? Or are we going to essentially rent it from an advisor and bring them in to help us on these deals because we just don't look at enough deals to keep an M&A team, a highly capable M&A team, busy full time. And that's always kind of been the calculus, right? But the difference now is that, again, I say it all the time, but with higher interest rates, that margin for error is lower. So as the strategics look to do deal and recognize the benefit of making those investments, they also recognize that, okay, we got to get serious about this. And whether we hire these people or pay an advisor to help us, we need, if we're going to be serious about doing any deals, even one deal every 3 years, we need to make sure that it's the right deal, and we have to pay for that expertise, either by building it in-house or through an advisor.
And that's a fascinating perspective because it seems like if you're doing only one deal once in a while, you're better off paying and renting up for that expertise until you decide you're really going to be in the deal business. Then you got to commit to it. And it's expensive to great deal teams. It's why some of these family offices, everybody talks once they've made a little bit of money about wanting to have a family office, but to actually do it in any serious way, you have to build a serious team, and you have to have a lot of money to do that and make it make sense.
I mean, absolutely. And it's, sort of deal advisories like any other sort of service you can buy, whether it's an attorney or getting a plumber, right? Having somebody build your deck. Like these are all services. And we know that there's variability in there too. So yeah, we've had, talks with some or seen observations of people trying to build up a team thinking it will cost a certain amount. And you can build up a team at, certain comp levels per head count, but those comp levels need to be competitive if you want to get a quality team in place. Like you can always find somebody willing to do any job for a price generally, but in this, like in many things, you kind of get what you pay for, especially in this rate environment where there is so little margin for error.
And if you want to do it right, you better do it with depth as well.
Yeah, absolutely, absolutely.
So which brings us, which I'll bring you back to discussion. We're with Matt Wolf of RSM. Matt, one of the things about RSM, it's got about the best depth of anybody in the business in this Q of E, mid-market, PE, private equity. talk about the commitment to having that depth and how important that is to do this right and do that well. Just take one moment there. I know it's a little bit of a commercial on RSM, but give us one moment on sort of the importance of that depth and what RSM's done to create that.
Yeah, the quick answer, although wasn't quick, was just industry focused, right? So we have teams that are dedicated to specific sectors and industries, and we've seen, while again back to that company that might do one deal every 3 years, we might do 12 deals that look very similar to that deal, every year or even a quarter, depending on the type, right? Like, so we very much focus our people on industry, on sector, on deal type, so that we can bring this broad perspective. And I think that's really important in any advisor. And I think RSM's done a great job of it, where we can go and say, yep, you haven't seen a deal like this, but we have seen many deals like this. And here's the team that's worked on all of those deals, and they're going to work on your deal too.
Matt, as always, I want to thank you for joining us today on the Becker Private Equity Business Podcast. It's always great to visit with you again. Matt Wolf, RSM, and sort of strategics hitting back in the game, and we'll see how it goes. Thank you for joining us.
Thank you.
Shop Macy's VIP sale going on now. Use your coupon or Macy's card and take an extra 30% off the latest fall trends from designers that rarely go on sale. And save 15% off skincare, makeup, fragrances, and more. Plus, shop fall specials for even more great deals on top brands at Macy's. Savings off regular and already reduced prices. Exclusions apply.